This part of the course is presented as Module 6, and the focus is stock selection, going deeper than earlier modules. The idea is practical, how someone might select stocks for trading versus selecting for investment. The workflow shown relies on a small set of websites and a repeatable process. First, filter candidates, then quickly sanity check fundamentals, and finally validate the setup on the price chart before thinking about entries, targets, and stop-loss placement. A key framing point here is that stock selection changes depending on the goal. For trading, the selection tends to emphasize what moves, things like volatility, volume activity, and clear technical patterns such as consolidations and breakouts, because the trader needs actionable entries and risk control. For investment, selection leans more towards business and financial strength, numbers like EPS and net worth, because the time horizon is longer and the decision is less about a near-term breakout. When the material talks about trading selection, it keeps returning to one idea. You don't just pick a company, you pick a setup. So the filter step tries to surface patterns like consolidation or breakout candidates. Then the chart step confirms whether the resistance and support levels are clean enough to define a target and a stop loss. The stock is tradable only if the risk plan is obvious from the chart structure. The overall workflow is presented as a sequence. First, open the necessary web resources. Second, use a stock filtering tool to narrow down a large market into a manageable shortlist. Third, before looking at the chart, quickly review the company's basic fundamental metrics that the tool provides. Fourth, move to the price chart and do technical analysis. Identify range, breakout, resistance, and support. Finally, if it's a trading setup, define the target and the stop loss from the structure. 3 websites are specifically referenced as the working toolkit. One is Nepse Alpha via nepsealpha.com. Another is Chukul, used as the first stop for filtering and utilities. And then Nepse Alpha's charting is used for the deeper technical view. The emphasis is not on memorizing menus, but on knowing what each resource is used for. Chukul to filter and categorize opportunities, and a charting page to validate the price action and structure. The sequence matters in the way it's taught. Filtering first prevents randomly scrolling charts with no plan. So Chukul is treated like the gatekeeper. You use its utilities to surface specific types of stocks: volatile, consolidating, trending, and breakout-related lists. Then, Nepse Alpha's chart becomes the decision stage, where the setup is either confirmed or rejected, based on resistance, rejection, consolidation behavior, and the ability to define risk clearly. Inside the filtering site, the instructor navigates by scrolling until a section labeled Utilities appears. The action is simple. Click into Utilities, and that opens a set of different services designed to classify stocks by behavior. The concept to take away is that these utilities are pre-built filters. Rather than manually screening hundreds of tickers, you start by choosing a behavior category that matches your strategy and let the tool generate candidates. Visually, the important part is just locating the utilities menu and recognizing it as the entry point to multiple screening options. The lesson is, don't overcomplicate the first step. Find the utility section, open it, and then pick the kind of stock behavior you're hunting for, like volatility, consolidation, or trend-driven activity. That choice determines what kind of setups you'll see in the list that follows. Under Utilities, the material mentions several distinct services. There's a value-to-risk style option, a volatile stocks list, a consolidating stocks list, meaning stocks moving inside a range, and a trending stocks list. Each one is essentially a different lens on the market. Instead of asking which stock is good, you ask which stocks match the condition I want to trade, and the tool answers by producing a categorized shortlist. 2 of these categories are especially central to the later chart discussion: consolidating stocks and trending stocks. Consolidation gives you clear boundaries, support and resistance, so you can plan a breakout trade with defined risk. Trending lists are useful when you want names that are already active, often identified by market participation signals like volume or transaction activity, which increases the chance the move continues in the near term. For trending stocks, the description ties the idea to activity, either on the basis of volume or on the basis of many transactions. The point is that trend lists are not purely about price going up. Rather, they highlight where the market is actively participating. In practical screening, this matters because breakouts and continuation moves are more reliable when many participants are involved, which shows up as stronger volume or unusually high transaction counts. The instructor's implied logic is liquidity and attention. Higher participation typically means tighter execution for a trader. Entries and exits are more feasible. And it also means technical levels like resistance or support can be more meaningful because more trades are occurring around those levels. So when using a trending list, the trader is essentially saying, show me stocks where the crowd is already engaged, then I'll check the chart structure next.
Beyond broad categories like volatile or trending, the utilities also provide more pattern-specific scans. The material names inside bar breakout options, both down and up, and also consolidation-based breakouts, again, down or up. These are essentially predefined technical situations. The key is recognizing what the scan is promising. It's not guaranteeing profit, it's narrowing your search to charts that might be approaching a decision point, where price could break above resistance or below support.
From the flow shown, the next focus is consolidation. That's a deliberate choice because consolidation is easier to interpret for many traders. Price compresses in a range, the boundaries are visible, and if a breakout happens, the trade plan can be structured. So the consolidation breakout scanners help you get to charts where that range then break story may already be forming, and then you verify it manually on the chart. A consolidating stock is defined here very plainly. It's a stock playing within a range. Price is not making consistent higher highs or lower lows. Instead, it oscillates between a visible support zone and a visible resistance zone. This matters for stock selection because a range gives structure. If a trader wants to trade breakouts, the consolidation phase provides the reference levels, where a breakout would be considered valid and where the idea is invalidated if price falls back into the range. The material also notes that within this consolidation context, you can think in two directions, an upper breakout above the range high or a lower breakout below the range low. That's why screeners often show both upper breakout and lower breakout ideas connected to consolidations. For trading, the job is to decide which side is more likely, but more importantly, to wait for price to actually confirm by breaking and holding beyond the boundary. After selecting the Consolidating Stocks utility, the tool shows a list, many stocks that are currently range-bound or associated with breakout tags like upper or lower breakout. The instructor then chooses an example from the list to explore further. The broader lesson is how to move from market-wide list to one candidate. Pick a name, click it, and then do the deeper checks, first fundamentals if available, and then the chart structure. Selecting one candidate, like the example ticker shown, illustrates the process of narrowing down. The filter step is not the decision, it's just the funnel. Clicking into a specific stock is where you begin validation. In the instructor's flow, that validation starts with quickly reviewing the company snapshot, then moving to the price chart to see whether the consolidation range and breakout behavior are clean and tradable. Before jumping to the chart, the material points out that you can view fundamentals right here on the stocks page. The examples mentioned include EPS and net worth, along with other figures the site displays. The role of this step is a quick sanity check. It's not a full financial analysis, but it helps you avoid being totally blind to the company's basic financial snapshot. Especially for longer-term investors, these numbers can weigh heavily in whether the stock even belongs on the shortlist. This quick check is best treated like a filter within a filter. For a trader, it might be enough to ensure there's nothing obviously problematic before committing attention to the chart. For an investor, these metrics may become a bigger part of the decision. Either way, the key teaching point is sequencing. Look at the snapshot first, then proceed to chart analysis, so your final decision combines both the company context and the price action reality. After the fundamental snapshot, the focus shifts to the chart, specifically a price chart for the example stock. This is where technical analysis begins. The instructor identifies a clear range first, then points out that price gave a breakout from that range. But the story doesn't end at breakout happened. The next question is what price did near the next resistance area. Did it close above and continue, or did it struggle and fail to follow through? The first technical step is defining the range itself, where price repeatedly bounced between support and resistance. This is important because without those boundaries, you can't objectively say what counts as a breakout. By marking the range high and range low, the instructor is creating the reference frame. Any move above the range high is breakout behavior, but the trade still needs confirmation from what happens next, especially around nearby resistance zones. Next, the chart is annotated with an immediate resistance level above the range. This becomes the key obstacle after the breakout. The material notes that even though price broke out, it could not produce a strong close above this immediate resistance. That's a classic technical read. A breakout that runs into resistance and fails to close through can lead to hesitation or a pullback, so a trader should avoid assuming continuation without that confirmation close. After failing to close above the immediate resistance, the price action shown returns into another consolidation, basically a reconsolidation phase. The instructor describes price spending several days moving within a smaller range again. This is a useful concept for stock selection because it shows that breakouts are not one-and-done events.
Often, price breaks, meets resistance, then pauses and consolidates again before making a clearer attempt. That second consolidation can sometimes offer a cleaner trade plan than the first breakout attempt.
The material specifically treats a certain candle as a support reference, meaning subsequent price action respects that level while consolidating. This is a practical way traders anchor risk. If the market is repeatedly holding above a candle low, that low can become a meaningful invalidation level. In other words, the chart is giving you a potential line in the sand. If price breaks below that reference, the consolidation thesis weakens and the trade idea may be canceled.
A major observation in the current scenario described is repeated rejection at the previous resistance level. The level that acted as resistance earlier continues to reject price multiple times. Technically, this reinforces that the level is meaningful. Market participants are reacting there repeatedly. For a trader, that can be both a warning and an opportunity. A warning because price hasn't broken it yet, and an opportunity because a clean break above a well-tested resistance can sometimes lead to a stronger move.
The teaching emphasis is on confirmation. It's not enough for price to poke above resistance intraday. The instructor keeps pointing to the idea of price being able to close above that resistance. Closing above suggests acceptance at higher prices. Without that, repeated rejections can continue. So in a stock selection context, a trader might keep this name on a watch list, waiting for a decisive close above the level before considering a breakout trade.
From this chart read, the material suggests the stock can be evaluated for resistance breakout trading. That naturally leads into trade planning. Identify where an entry would be considered, typically around the breakout above resistance, then set a target above based on the projected move or next visible area, and define a stop loss. The stop loss is described as being placed at the low of a key candle or at a swing low, because those are the structural points that, if broken, invalidate the setup. This stop loss placement is tied to the earlier idea of a support reference candle. The instructor's approach is structural. The stop isn't random. It sits where the chart says the buyers previously defended. If price breaks below that candle low or swing low, it signals the consolidation support failed, and staying in the trade no longer matches the original logic. This is where technical analysis connects directly to risk management. Selection is incomplete without a clear invalidation point.
What this section establishes is a routine the learner can repeat. Open the same set of resources, use utilities to filter the market by behavior, and then validate candidates with a quick fundamental snapshot and a deeper chart read. The chart work focuses on recognizing ranges, spotting breakout attempts, and paying attention to immediate resistance and repeated rejections. Once that structure is clear, it becomes possible to define targets and stops logically, which sets up the next part of the discussion. Picking up right where we left off, let us look at resistance breakout trading. Once you have filtered your stocks, the next crucial step is defining your target and stop loss levels. On this chart, we establish our target above the resistance line, but more importantly, we must determine where our stop loss goes if the trade turns against us. Notice this recent swing low, specifically the closing of the previous red candle. This is exactly where our stop loss should be placed. If you buy at the last traded price, your stop loss might sit around 6% below your entry. However, precision matters immensely when managing your downside risk in these setups. If you wait and buy specifically within this breakout zone rather than chasing the price upward, your stop loss shrinks to around 4%. Both scenarios require technical analysis to plan your trade effectively. You must always calculate these exact target and stop loss percentages before executing any buy or sell orders. Moving on to consolidating stocks, we can dive deeply into broker analysis. This allows us to see exactly who is buying and who is selling heavily. By examining the daily buying and selling data, we might spot, for instance, broker 21 purchasing 200 units at a specific price point, like 983. When we switch to the weekly time frame, the data often reveals much larger moves. You might discover that broker 34 has accumulated 10,000 units over the week. Tracking these specific broker activities helps us identify if a major player is quietly accumulating shares, while the stock appears to be just moving sideways. However, if we check the monthly data and see only a few hundred units traded, it tells us there's no significant accumulation by any single player. In consolidating stocks, finding heavy, concentrated buying by specific brokers is key, as it strongly increases the possibility that the stock is preparing for an upward breakout. Now, let us shift our focus to trending stocks by looking at top turnover data. These are the stocks contributing the most to total market transactions. For example, you might see Kumari Bank Limited with over 16 crore in turnover, or heavy activity in Nepal Reinsurance Company and Radi. These represent the highest liquidity pools. When you are compiling your top 10 list from this high turnover data, you must be careful to exclude certain types of shares.
Promoter shares or newly listed IPOs should not be included in this specific analysis. Filtering these out ensures you are only tracking standard, freely traded public shares driven by true market momentum.
It is highly recommended to note these tickers down on paper to easily spot patterns. You want to look for common names that repeatedly appear across different lists. Tickers like Shell, NGPL, RODI, NRN, and HRL showing up consistently means they are currently dominating market trades and require your immediate attention. Once you have identified these heavily traded common stocks, you cannot just jump in blindly. You must evaluate their technical setups, check their fundamental standing, and verify if major players are buying. We will explore how to apply proper risk management to these exact scenarios as we continue our analysis.
Continuing with our market scenario insights, let us look at the stock NRIC. When we open the NRIC data, we first analyze the broker activity on a daily basis. We can see the top buy, top sell, top holding, and top release metrics. For instance, Broker 6 bought 6,000 units, and Broker 5 bought 7,000 units, while Brokers 9 and 7 were among the top sellers.
While daily data is useful, monthly broker analysis provides a much better picture. Over a month, Broker 5 accumulated over 400,000 units. However, we must be cautious. Sometimes large players buy from one broker, like Broker 5, and shift their shares to sell from another, like Broker 9 or 34, to mask their distribution.
Moving beyond broker data, we must apply technical analysis. Looking at the NRIC price chart, we first identified the previous resistance level. In smart money concepts, breaking this level is referred to as a break of structure, or BOS.
We can annotate this chart by placing a text label for BOS right at the bottom of this resistance breakout. Marking these structural shifts helps us clearly see where the market dynamics are changing and where buyers are overpowering sellers. We also notice a downward trend line where the price has not yet fully sustained momentum above it. While the technicals show price consolidating above the main resistance, we should always cross-verify with fundamental analysis. Checking metrics like the price-to-book value ensures the stock is not severely overvalued before we commit.
If NRIC successfully breaks out of this consolidation zone, we use the Fibonacci extension tool to project our targets. By enabling the 1.414 and 2.414 levels, we establish our exact profit-taking zones. It might take some time, but the probability of achieving these targets is quite high.
Before executing any buy order, defining the stop loss is mandatory. For NRIC, our stop loss must be placed just below the recent support level, which previously acted as resistance. This setup gives us a very manageable risk of around 5 to 6%, while our potential target offers an excellent 20% reward. Now let us examine trending stocks using the TooCool tool, specifically looking at the OHL chart. One major benefit of this tool is its automatic identification of market structure. By adjusting the settings and removing the Bollinger Bands, the tool clearly maps out the higher high and higher low formations for us. Furthermore, the tool utilizes AI to automatically generate trend line, support, and resistance levels based on previous candle highs and lows. This gives us an immediate objective view of where the critical turning points are likely to occur without having to draw them manually. For our OHL trading plan, we identify our entry zone near the support, keeping an eye on the volume. High volume suggests a strong possibility of upward movement. If the price falls below our stop loss, we exit immediately. However, we do not ignore the stock. We simply wait to plan a new entry at the next lower support zone. Next, we utilize the screener to find specific candlestick patterns, such as insider bar breakouts. An insider bar down breakout occurs when a candle breaks the previous swing row. Conversely, an insider bar up breakout, like we see in the CYCL stock, happens when a pin bar breaks and closes above the previous highs, signaling a strong buying opportunity. Finally, the screener helps us identify consolidation breakouts. We look for stocks that have been moving sideways in a tight zone for days, like Forward or Standard Chartered Bank, and then suddenly break out of that range. Combining these technical breakout strategies with broker data is powerful, which leads us directly into evaluating the fundamental zone next. Moving right along from breakout strategies and technical charts, the next critical step in filtering stocks is entering the fundamental zone. While technicals help with timing your entry and exit, fundamentals ensure you are looking at the right assets to begin with, especially when analyzing top trending sectors like hydropower. Within this fundamental zone, you can specifically filter for low-cap companies, which often have explosive growth potential. By sorting the total floated stocks, or the shares held by the public, you can easily identify stocks with extremely low public holding. For instance, clicking the sort arrow brings up companies with the lowest available supply, like KBSHL. Next, you can shift your focus to profitability by examining the latest quarterly reports. Let us look at specific companies like Sahas, AHPC, and NHPC. It is absolutely essential to compare their current market prices against their floated stocks, earnings per share, and net worth to see the full financial picture. For example, if you compare Sahas directly with AHPC, you'll notice AHPC has a lower market price, around 283. However, when you look closer at the underlying data, AHPC also has significantly lower net profit, EPS, and net worth compared to its peers, making it a completely different risk profile. Let us select a specific stock, such as Shell, for a deeper dive into its metrics. The market price sits at 264, with a public holding of 290,000 shares. The net profit is around 10 crore, which is decent, and the EPS and book value are sitting at average, acceptable levels for this sector. Once a stock like Shell is selected, the immediate next step is to check the monthly broker holdings to gauge institutional interest. In this specific case, the monthly data shows relatively low buying interest, with top broker holdings only amounting to around 100,000 to 160,000 shares. Because she lacked strong accumulation, we can search for better opportunities using the exact same net profit basis, leading us to a stock like API. Looking at the monthly broker slips for API reveals a much stronger, more promising picture, with significant and sustained buying activity from major market players and institutions. Broker 34 bought nearly 300,000 shares, and Broker 1 bought around 280,000 shares. This heavy accumulation aligns perfectly with our previous successful technical trade on API, where we bought exactly at support, rode the price increase, and strategically scaled out near the previous resistance level. Shifting our focus to the banking sector within the fundamental zone requires looking at slightly different key metrics. For banking stocks, the most critical factors to evaluate are the company's net profit and earnings per share. Institutions like Nabil Bank often stand out here due to their consistently high net profits quarter after quarter. Using EPS and net profit as your reliable guide, you can select robust banking stocks for your long-term investment horizon. Consider choosing two solid banks, perhaps NBL, Standard Chartered, or Everest Bank, and commit to investing a set amount every single month or quarter to build a strong, fundamentally sound portfolio as we move into the next phase of our strategy. When approaching long-term investments, one highly effective strategy is to select reliable sectors, such as banking, and commit to a consistent investment schedule. By investing a set amount every single month, or perhaps on a quarterly basis, investors can steadily accumulate shares over time. This disciplined approach often yields substantial returns. While institutions like Everest Bank or Nepal Telecom might be used as examples due to their strong support levels and widespread daily use, it is critical to remember these are just examples. Investors must always conduct their own thorough research and analysis rather than blindly following any specific stock mentions. Beyond the banking and telecommunications sectors, life insurance companies present another excellent avenue for long-term holding. A very practical and relatable approach for beginners is to look into the specific company where they already hold a personal insurance policy, provided that the company's underlying fundamentals remain strong and stable. When filtering stocks, the analytical approach must shift based on the intended time frame. Whether looking at short-term trades or long-term investments, market participants should always verify current broker holdings and carefully examine basic fundamental ratios to properly gauge the financial health and overall momentum of the underlying company. For short-term trading specifically, certain metrics outweigh others. The price-to-book value ratio becomes incredibly important in this context. While earnings per share is generally a fantastic metric for long-term growth, the price-to-book value often dictates short-term trading viability much more effectively and should be prioritized. Furthermore, traders must diligently categorize their prospects into low, mid, and high capitalization tiers. The specific trading strategies and risk management parameters for each capitalization tier differ significantly. Applying the correct tailored strategy to the corresponding market cap tier is an absolute necessity for consistent trading success in the broader market. Congratulations on reaching the very end of this comprehensive journey. This educational material was designed specifically for absolute beginners who started with zero prior knowledge. We aim to guide individuals from not even knowing how to open a basic brokerage account to confidently understanding core market mechanics and trading principles.
The primary goal throughout these sessions was never to impress anyone with overly complex financial jargon, but rather to truly empower the individual. By now, every participant should feel highly capable of stepping into the live market and generating a modest, steady income through well-informed, independent decisions and strategic planning.
Moving forward into live markets, the most crucial piece of practical advice is to start with a very small amount of initial capital. The stock market is notoriously a harsh teacher, and valuable practical learning almost always comes through experiencing a few inevitable initial financial losses during the early stages. Starting with a minimal amount ensures that those inevitable early mistakes will not be financially devastating. Bringing in massive capital right away often leads to significant, painful losses. This can completely demotivate a new trader, ruin their psychological state, and permanently push them out of the financial markets before they even truly begin. Long-term success in the share market is entirely dependent on strict discipline, unwavering consistency, and immense patience. New market participants should actively dedicate a minimum of 1 to 2 hours every single day solely to chart analysis, market research, and continuous financial education to build a strong foundation.
It is absolutely vital to understand that expecting consistent daily profits from day one is a dangerous myth. It generally takes 2 to 4 full years just to learn the ropes and survive. However, those who can weather this initial brutal learning curve will find an incredibly rewarding future ahead.
Finally, the ultimate takeaway for this entire journey: avoid the dangerous trap of seeking fast money. The market will severely punish impatience. Even if someone manages to make quick, lucky profits initially, a lack of strict discipline will inevitably and rapidly turn those temporary gains into devastating long-term losses.